The Fed raised its rates again by 0.25% to fight inflation despite concerns it could worsen turmoil in the US banking system. So let's dive into today's video. Hi, my name is Sunny, and a quick like, share alongside smashing that like button will be highly appreciated. Recently, the Fed raised its key short term rate by 0.25% in an aggressive campaign to tame inflation despite financial turmoil following Silicon Valley Bank's collapse. No doubt it will constrain bank lending while weakening economy and inflation, but Fed is forecasting at least one more possible rate hike this year. Some experts believe SVP's meltdown is in a way equivalent to a rate hike if you consider effect of this bank run alongside counterparty risk broadly on the US economy. As banking stress in the US has eased a bit lately, economists were debating if Fed will increase rate by quarter percent. That would have given some relief to markets who were predicting half a percent hike before the banking crisis. Job growth, pay increases, and consumer spending have all gone up recently, compounding inflation concerns for the US Central Bank. Lately, the Fed was very vocal in its public comments to instill confidence in the banking system, where the goal was to avoid uncertainties or complications in the markets and the broader US economy. Stock market went down after US Federal Reserve announced its latest rate hikes while stating they will have see and act policy on the rate and economy going forward. All three major US indices were flat before the announcement but fell sharply towards end of the trading day even though this move was exactly what Wall Street was expecting. The Fed hinted it may not raise rates further as they want first to evaluate fallout from recent US banking crisis, and if required the rate hike posture will change from maybe to we will. The yield on a 10-year US Treasury that acts as a base for mortgages and other loans fell from 3.49 to 3.61% late on Tuesday. The Canadian dollar or loonie strengthened against its US counterpart on Wednesday as investors cheered at a signal by the Fed that it is nearing a pause in its monetary tightening stance. Loonie was trading at 73.21 US cents, which is its strongest level in recent weeks. Experts believe the Fed is doing its best to put on a brave face by raising rates while doing quantitative tightening, but money markets are expecting another small rate hike or even a rate cut in coming months. Domestically, new home prices fell slightly month over month in February as increased mortgage rates slowed housing demand, which is a major component of Canadian economy. Average house prices in Canada has gone down by about 20% year over year in some regions, but experts believe there is more downward potential since uncertainty still remains about inflation and future rate hikes. Consequently, some investors are getting excited, so we are seeing even multiple offers back again. Sellers too are now willing to settle for lower prices as new realities make sense financially for buyers. Avoid being emotional about any real estate deal, rather focus if it makes sense financially to invest. Don't you think the sole reason we deploy our money is for a return, but with a reasonable protection expectation for our investment? Recession is coming, the question is how deep or shallow it will be. The ongoing stress in banking system will further impact credit availability where real estate, a small business or even big corporations will be impacted. Inflation, rate hikes and a sort of shaky confidence in the banking system are bound to lower consumer demand alongside subdued investment activity. Even Goldman Sachs have now increased their weightage towards possible recession, but they were little more optimistic earlier. All indicators are showing challenging times ahead. Difference is how tough and for how long such times will last. For sure, Fed was stuck between inflation and a rate hike, but recent banking crisis is not helping either. They have to make a choice based on some of the lagging indicators, which I know is not an easy job. A pause in rate hikes could signal Fed is not confident about resilience in the banking system or economy, whereas more rate hikes could inflame current banking crisis. Historically, they have avoided tightening monetary policy during times of financial stress. The Fed has been steadily reducing size of its balance sheet lately, which has again swelled up as they try to prop up the banking system. But that is me, I might be wrong. As a disclaimer, I'm not a financial advisor, so please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.